Hey everyone, welcome back to Knowfin. Today we're jumping straight into a totally essential explainer on the 2026 Indian economic landscape. We are literally going to build a definitive financial asset map together. Why? Because the financial world moves incredibly fast, and honestly, what worked for us a few years ago has completely evolved. By the end of this explainer, you're going to have a crystal clear, structured understanding of the modern investment terrain, so you know exactly where to park, protect, and grow your wealth.
So here is our roadmap for today. We're going to start with cash equivalents, move into fixed income, jump over to equities, explore crypto, and wrap it all up with real estate.
Section 1. Cash equivalents. The safe shallows.
Think of this as the absolute bedrock of your portfolio. It's the designated home for your emergency fund. Basically, these are highly liquid, SEBI and RBI-regulated instruments where your surplus cash just sits safely. We're talking your standard bank savings accounts, for sure, but also liquid mutual funds. And those liquid funds are great because they invest in incredibly short-term debt instruments, stuff like treasury bills and commercial paper that mature in just 91 days. The whole point is that your money is literally never locked away out of reach.
So, what's the vibe here? The risk level is extremely low, and the liquidity is incredibly high. It is completely accessible, kind of like a reassuring deep blue safe zone. If your car breaks down tomorrow or you get hit with a sudden medical bill out of nowhere, this is the exact pool of money you tap into instantly.
But, there's always a trade-off. For Indian investors right now in 2026, the huge pro is unmatched safety. Your bank deposits actually come with DICGC insurance up to 5 lakh rupees, and the RBI mandates a base interest rate of 4%. But the glaring con? Those 4 to 7% returns are basically just fighting a losing battle against inflation. You're getting total safety, yeah, but you are completely sacrificing real long-term wealth creation.
All right, moving to Section 2, fixed income, steady returns. Now, when you step into fixed income, you are essentially playing the role of the bank. You're lending your money to a borrower, maybe a major bank, the government, or a big corporation. And in exchange, they promise you regular interest payments and the return of your initial principal when the term is up. By locking your cash away for a set tenure in, say, fixed deposits or bonds, you completely shield yourself from the daily roller coaster of the stock market. You're just relying on those predetermined, guaranteed repayments.
We're stepping slightly out of the shallows now. The risk bumps up to low to medium, and liquidity drops down to medium. Sure, you can usually get your money out if you're really in a bind, but breaking that term early almost always comes with a penalty. You are deliberately trading away that instant click of a button liquidity for a slightly better yield.
And the 2026 reality check here is super fascinating. The major pro is capital preservation with guaranteed returns. Right now, major banks are throwing you around 6.25 to 6.5% for 1 to 3 year tenures, plus an extra percent if you're a senior citizen. But there are two massive headwinds. First, every bit of that interest is fully taxable at your income tax slab rate. Second, remember that RBI repo rate cut down to 5.25% back in December 2025? Well, that actively dragged those FD rates down with it.
Let's shift gears to Section 3. Equities, the wealth creation engine. If cash and fixed income are your defensive shields, equities are absolutely your sword. Buying equities means you're no longer just lending money to a business. You are literally buying a piece of it. You're claiming a direct, undeniable share of a company's future profits through dividends and capital appreciation. Now, for anyone looking for the easiest entry point, equity ETFs, exchange-traded funds, are a total game changer. Instead of stressing out trying to pick the next big winning stock, an ETF lets you passively track an entire market index like the Nifty 50. Boom, instant diversification with just a single purchase.
Obviously, volatility kicks in hard right here. The risk is undeniably high because stock prices swing wildly every single day based on global events, earnings reports, and honestly, just human psychology. But the silver lining? Market liquidity is also sky high. During trading hours, you can buy or sell your shares with a simple click and have your wealth back in cash in just a couple of days.
The upside here is just historic. It remains the absolute best wealth creation tool we have, boasting beautiful expected long-term returns of 12 to 15%. But 2026 definitely brings some serious baggage. Alongside the natural market volatility, which, by the way, SEBI is aggressively trying to manage right now with new plus or minus 10% price bands on ETFs, the taxman is taking a much bigger bite. Short-term capital gains tax is sitting at a steep 20%, and long-term gains are hit with 12.5% above a 1.25 lakh annual exemption. You really need a steady hand and a long-term mindset to play this game. Which brings us to Section 4, crypto, high-risk speculation. In India, we officially call these virtual digital assets, or VDAs. We're talking about decentralized networks like Bitcoin and Ethereum. The single biggest thing to wrap your head around here, the thing that makes crypto entirely different from literally everything else we've talked about, is the total lack of intrinsic cash flow. A normal company produces goods and pays dividends. A property generates rent. Crypto? It doesn't either. It relies purely on price appreciation. And because it's purely speculative, just trading it now requires intense identity verifications. I'm talking mandatory penny drops to verify your bank account and live selfies with liveness detection just to get onto an exchange. The risk profile? Absolutely off the charts. High. Prices can surge or totally collapse by double digits while you're out to lunch. Now, liquidity is actually pretty decent on major platforms, medium to high, since crypto literally never sleeps. But make no mistake, this entire ecosystem is highly aggressive and totally unforgiving if you aren't prepared. And here is the absolute biggest hurdle staring down Indian crypto investors today: an unavoidable, massive 30% flat tax on all your gains. We are looking at a really severe regulatory squeeze. Now, there is a silver lining. Expected SEB registration mandates coming by budget 2026-27 should finally force some transparency and make the platforms themselves way safer for your actual funds. But that punishing tax regime? Ouch. That 30% flat tax comes bolted to a 1% TDS on transactions, and the government gives you absolutely zero allowance to set off your losses against your gains. It severely eats into profits and pretty much destroys typical active trading margins.
Finally, Section 5, Real Estate, Tangible Growth.
We've reached the heaviest, most physical asset class on our map. Investing here means sinking capital into physical land or buildings to earn rent and capital appreciation. Traditionally, if you're buying brick-and-mortar property, you are looking at a massive barrier to entry. You need 10 lakh rupees minimum, usually way more. But thankfully, modern finance has given us a brilliant alternative: REITs, or real estate investment trusts. These are SEBI-regulated listed instruments that let you buy fractional ownership in massive commercial real estate portfolios for as little as 15,000 rupees. The characteristics for real estate are totally split. The risk is medium to high, mainly because of the sheer size of the investment and shifting market cycles. But liquidity is the real story here. Physical property has incredibly low liquidity. It can literally trap your capital for months if you suddenly need to find a buyer and cash out. Listed REITs, however, offer a much-needed medium liquidity alternative since they trade much more like stocks on an exchange. The 2026 game changer for this sector is completely regulatory. See, traditional residential rental yields in major metros are honestly just sluggish right now, hovering around a very low 2 to 4%. But commercial properties, they are pumping out robust 6 to 9% yields. To capitalize on this, SEBI actually reclassified REITs as equity-related instruments effective January 1, 2026. This is huge because it allows mutual funds to count REITs toward their equity allocations. That is expected to massively boost institutional buying and breathe a ton of fresh life into the space.
Okay, let's take a breath and step back. Look at this incredible 2026 map we've just built together. We've got everything compared side by side. We go from the low-risk, highly liquid cash equivalents, meant for those absolute emergencies, right through the stable preservation of fixed income, up into the high-yield wealth creation engine of equities. Then we see the aggressive, wild speculation of crypto, and finally, the heavy, long-term diversification of real estate. I'd honestly highly recommend you grab a quick screenshot of this strategy map right now for your records.
So now that you have the complete map to confidently navigate the 2026 investment landscape, I want to leave you with one absolutely crucial question to ask yourself today. Take a hard look at your own accounts. Is your current portfolio truly anchored where it needs to be to hit your personal goals? Or are you maybe taking on hidden risks, or even worse, not taking enough risk to outpace inflation? Thank you so much for joining me on this Knowfin Explainer. Keep learning, keep structuring that wealth, and I'll see you in the next one.